guys, welcome back everyone, and welcome back to our channel at FXStrategies.asia. Today we have another VIP guest, the one and only Paul Hodges. The last time I asked Paul a few questions is quite a while ago, and I hope from this to the next interview with him, we don't take that much time as well, because his insights are not only valuable, but also they are spot on. Third, they give you quite some valuable insights about the general economy, about how everything is interacted together, and how much of the chemical industry you can take for your own use. So now sit back and relax and listen to what Paul has to say. Paul, thanks a lot for your valuable insights. And for the ones of you who don't know, the chemical industry, according to him, is the leading industry. And the more I've been watching and looking into his newsletters, then obviously I might say, shit, he's really right. He really gets it spot on quite often. So Paul, first question, where in the current cycle are we in terms of the chemical industry? Are we still kind of seeing an uplift, or is it just a total disaster?
I think, unfortunately, Frank, we are, as you say, we're the leading indicator for the global economy. And perhaps if I just explain why that is, we're a very large industry. We're the third largest in the world after energy and agriculture. We go into every possible corner of life, and we're relatively early in the value chain. So lots and lots of times on the way up or on the way down, what we are seeing, people say, oh, that's not right. 6 months later, they discover it is. Unfortunately, in reply to your question, the news is not good. The chemical industry is in, and I hesitate to say this, but it's in a state of near disaster. And we can go into that reasons for it, if you like, in more detail. Essentially, we've always had, it's a cyclical industry. Things go well. People decide to build new capacity. They overbuild because they get overexcited. Demand goes down because central banks push up interest rates. So there's a down period. But at the down period, normally, companies stop investing and they say, oh, got this wrong. And then gradually demand picks up. And of course, at the end of, that balances. And then we go back to having good times. So if you look over a 5 or 7 year period, chemical industry has 2 or 3 very good years, a couple of bad years. And in between, you get by. That's how it's been since it was invented back in the late 1950s, early 60s. This is different. And we can go into why that there.
I already have a ton of new questions in my mind, but I'm afraid the time will not be long enough actually to get all them answered. Looking at the current imbalance in markets, and I'm eyeing the Nasdaq. The Nasdaq down at 24,800 points, roughly, right? So it seems to be now that the AI industry is just overtaking itself, right? Is that something from the chemical point or eye of view also, where you look at a certain disaster on the horizon?
Well, I think what we're seeing in AI is the same. The AI bubble, as I think we should call it, is very similar to the bubble that's been developing already in chemicals. Again, unfortunately, we've been a leading indicator. Reason for that is lots and lots of cheap money from the central banks. Have as much money as you like. Zero interest rates, so you don't have to earn any money. If your business doesn't make any money and can't afford to repay its interest, don't worry, we'll refinance. And so bad business models don't get punished; they continue, and everybody goes on, not necessarily making money. I mean, 20 or so % of companies in New York haven't made any money for 3 years. I see the figure in China is even higher there. So that they're not earning enough to pay their interest. What you've got with AI, I mean, AI has been around a very long time. I was talking to someone who was doing AI at Edinburgh University in the early 1970s, right? So AI is not new. When you get on a plane today, the pilot doesn't fly it unless there's a problem, in which case you're glad that the pilot is there. So this excitement about, it's going to change everything. Oh, come on, really? And so we're just seeing. We think we're publishing our report today for our clients, and we're looking back at the parallels with the dot-com bubble, which was exactly the same thing. We had some microsystems selling at 10 times revenue. And you think, well, that's impossible, because you basically, you'd have to have all, in order to pay back shareholders, you'd have to give them all your revenue with no costs at all, no dividends or anything else. It's ridiculous. But actually, the Magnificent Seven are on a price earnings ratio today of a sales earnings ratio of 9.59. Exactly the same. It's the same as 2000, unfortunately, and it will go the same way.
Early on as well, in one of the recent newsletters, I recall you've been talking about in particular, European chemical industry. Would you see a difference between Europe, say China as well, and the US? Maybe you can give us some outlook on either one of them.
Well, they're all. You may remember Tolstoy's famous novel Anna Karenina, which starts by saying all happy families are happy in the same way, all unhappy families are unhappy in different ways. And so that is a parallel really for what's happening today. Europe, we have high energy prices because of the Russian invasion, and we've got therefore, so we've got a cost disadvantage, which we can't do very much about, unfortunately. The States, we have a situation where the shale gas revolution meant they had this byproduct called ethane. And nobody really cares too much about ethane, apart from the fact that it's explosive. And so if you're trying to sell natural gas from shale gas, you have to extract a lot of the ethane, because otherwise your cooker in New York in the condo explodes. And for some reason, people don't like it when their cooker explodes, etc. Or maybe even the pipeline explodes, taking it up from Houston to New York. So you have to get rid of it, and you can't burn it, obviously, because of greenhouse gases and everything else. The only thing you can do is make ethylene. And ethylene is a very valuable product, but if you expand production in the States by 40%, 40%, in order to use this ethane, you've got problems, because the US market, as people said at the time when this began, is not expanding, it's mature. There's a limit to the amount of polythene you want, and so on and so forth, and it's reached it. So you've got that. You're on the second side, in the Middle East, you've got a problem where obviously China and Europe, and even to some extent the States, but also Southeast Asia and so on, and Brazil, are moving now towards electric vehicles. So if you're an oil producer, you're losing your core market of transport. Transport is 40% of all oil demand. And unfortunately, because the chemical industry compared to oil is so small, the oil industry's come up with this idea of, it doesn't matter, the chemical industry will always expand and it can take up all our capacity. Come on. We're the flea on the tail of the donkey here. The donkey is the oil market, the tail is the refineries and the gas production. And we are just this little flea. We can't possibly expand that much. But they've gone ahead and they've built all these new plants. And at the same time, dear President Trump has decided to have his trade war, and he did a trade war in his first term after 2017, and China decided, well, we have to move towards self-sufficiency. We can't be dependent on the States anymore. So you've got three major regions all investing in massive amounts of new petrochemical capacity, and clearly there's no demand for it. So that we are in this situation again, the flea on the tail of the donkey in Europe, unfortunately, but it doesn't help us. It's just a disaster.
And you mentioned because of the Russian invasion in the Ukraine. Well, we know that, but isn't it just the to some extent maybe the dumb European leaders who say, like, look, we now buy petrochemicals, oil and gas from the US, instead of still saying, look, we want to still get some from Russia in order to get some cheap energy supply? Or what would you say is a better way out to kind of get prices in Europe in terms of energy supply down?
Well, we're an industry, like most actually, which have long time scales. And when you build a chemical plant, it takes you 5-7 years to build it. It's a $10 billion thing. I mean, I've built them in Thailand. I've built them all over the world as an advisor, and then before that, as a producer for ICI. And and they live there for 30, 40, 50 years. All the parts change and everything, they wear out, they're replaced. But they're still there. So the mistakes that were made go back in Europe to Angela Merkel. And she made Germany dependent on Russian gas. And as a result, when she should have been moving it to renewables. As a result, we have a land war in Europe for the first time since the Second World War. And it's a brutal land war, brutal. And it's not at all clear. Ukraine needs support. Europe is supporting it pretty well at the moment, thank goodness. But if we don't, Putin has made it very clear his first target after Ukraine will be to restore the boundaries of the Soviet Union. And after the Soviet Union, he will clearly come in other places. I mean, he's said a number of times, he's got his new missile, for example, and he boasted the other day that one of these new missiles could put the whole of Great Britain on the bottom of the Atlantic. This is not a very nice man, unfortunately. So the idea, people like Hungary, who are Putin supporters, oh yes, we want to carry on buying from him and so on. But if you buy from him, you finance his war. So Merkel got us locked into this position where she didn't do renewables, she didn't do what she should have done, and so the German economy is now in a major state because it became dependent on gas, and it has to move away, and that will take another 5 years or so. So we're in for a pretty hard time. But it's mistakes that were made. It is to a large extent our own fault.
So according to you, then, would it still, if we can still get the change towards renewable energies, would you still see in the next 5 to 7 years potentially another increase in capacities, another increase in the chemical industry in Europe if the transition very late but still is ongoing, or would you say too much damage has been done already by now?
What I'd say is that we're moving into a third period since the Second World War. If you take a sort of broad brush, Frank, approach to history, what you see is after the Second World War, you were divided into two areas: the Soviet Union and the West. And the Berlin Wall was a symbol of that, but everybody was involved. If you were in Africa, if you were in Asia, in Latin America, you were on one side or the other. Then the Berlin Wall fell, communism collapsed, and we had this wonderful period of globalization. Well, that came to an end with the Ukraine war. And of course, what we have to remember is that demographics is destiny. And so what happened after the war was that we had this phenomenal number of babies born. If you look back at the number, what you see is in the States, for example, in the 18 years after the war, there were 52% more babies born than in the previous 18 years up till 1946. Now, inevitably, you get a fantastic amount of inflation because, you have all these babies who are creating new demand for the first time, but babies don't produce very much. So you have inflation. So that takes you. No, I don't blame Milton Friedman because he didn't have the data. When he was writing in the 1960s, nobody knew that a 52% rise was taking place. You might say there seem to be a lot of babies around the street these days, but that's about as far as it went. It was only in the late 1970s that the word baby boomer came into existence. So I don't blame Milton; he was wrong, but you can excuse him. You can blame, of course, the central banks. You can blame them because they should have realised they did have the data, but they arrogantly said, "Oh no! After the dot-com crisis and then the great financial crisis, they said that we can always create demand." Well, the problem is that, and it's not really a problem; it's actually a benefit, and therefore very good news in the end for chemicals and for other industries, is that people who are the baby boomers, they didn't die, or they're not dying at the age of 65 at pension funds, as pension age, as they would have done in 1950. They're actually living to 75 or 80. Now, they're lovely people and very, very, lovely to have around the house and everything else, but they're not having children. They're actually retiring from work, and they already own most of what they need. They're a replacement society. So if you go back, and just give you a personal example, I was working for ICI, which is the largest company in the UK, second largest chemical company in the world, and we moved to the States in the mid-1980s. And we took with us one container, and when we came back, we had two containers because we'd had another son out there, and the boys had grown, and everything else and so on, as you know. And so you're forever catching up as the family expands. As you earn a bit more money, you can get a better house, and so on and so forth. Now, when we moved to Portugal a few years ago, we came with one container, and we didn't need anything else. After a while, my wife said, I think I'd like a new sofa. I said, the sofa is perfectly fine. You know what this is like, how this story ends. We got a new sofa. But it was a replacement sofa. It wasn't our first sofa. So my point, Frank, is that we've no longer got growth in the global economy. 9 of the top 10 economies in the world, the main source of population growth now is these perennials, the over 55s, who are a replacement economy. Now, what that means is you move away, and this is good news for the environment, very good news, because it means you're not going to be producing lots of stuff anymore, because the boomers don't need lots of stuff, and they didn't have enough children. The boomers go back to 1970. They've been below fertility rates of 2.1 since 1970, which is why the population of people in the 25 to 54 age group is declining. So that's good news for the environment, but it means that you become a more service-related business. You have to, instead of saying, here's more stuff. Hey, Frank, do you want a new car? Hey, Frank, do you want a new house? Hey, do you need a new sofa? Do you need some new kitchen stuff? Do you need some new clothes and so on? You don't anymore. So what do you need instead? You still need food. You still need transport. I mean, there's some very interesting things happening in the area of robo-taxis, for example. People need transport. And originally, 150 years ago, transport was horses. Then transport today became cars, right? Fine. But what about, and it seems that we can do that, Baidu and Pony AI and so on, and Waymo and Wave in the West, they've got technologies now that can enable a robo-taxi to work. Now, a car, this is a very exciting thing. A car is on the roads for about 4% of the time, 1 hour a day. The rest of the time, it's in the garage. And most of that hour is often in traffic jams. I've been around Southeast Asia, the same as the States and everywhere else. It's busy. And you've got all the data because of Uber and Lyft and Bolt and the others and Baidu. You've got all the data now that you know where cars need to be, where I'm going to go at 9 o'clock in the morning, where my wife is going to go at 8 o'clock, and so on, and where you're going to come back. So you could have robo-taxis. And what you're finding already is they don't have accidents because they are, but relatively speaking, they're much safer than human drivers. And secondly, they're very much cheaper. So as long as you've got reliability in the system, which I think is where we're going to get to, then robo-taxis will take over. So the number of cars that you have on the road will reduce. That's my argument about you'll have less stuff, but you'll still get the same deal. So you'll be paying a daily rate, if you like, rather than $20,000, $30,000, $40,000 for the car. So that's the kind of transition that we see going on now. And so it's more, all these demands of food, health, shelter, transport, health, and so on, that they're all going to stay the same, but we're going to have a great excitement in terms of finding new ways of meeting those needs.
So obviously, I understand correctly. So like the global chemical industry is just leading you to the conclusion that everything is just not in a good shape. But the current situation where you said, okay, in terms of transport, as one great example, you said we see a shift. Do you see the current weakness is more like cyclical, or do you see it's more structural?
As I say, it is. We do take the view that demographics is destiny, and there's an awful lot of evidence that spending depends on age. if you look at any country in the world, I can show you Japan, I can show you Thailand, I can show you the States, I can show you Germany, the UK, whatever you like. It all shows that up to the age of 24, 20, or so, you're really studying. You're maybe going to university, you may be doing an apprenticeship or whatever. You have some demand, but a lot of your money and so on comes from your parents. 25 to 54, you're in what we would call the wealth creator period. You go out, you start to work and earn your own money for the first time. You may settle down, you may buy a house, you may sort of have children, and your spending goes up. But at the same time, your production goes up, so you get balanced between the two. And then at the age of 55, you then move into what we call the perennials, where you're a replacement society. And so where we are now is we're in that transition for the third big transition after the Second World War, where we're moving into a world which is actually less about stuff and more about services. And it's a digital economy, as we know. So I'm not arguing about the underlying digital thing. Give you an example. When the car took over from horses, two things were clear to that. Well, one was environmental, strangely enough. The people were incredibly worried about the amount of horse manure that there was on the streets. And they were saying, look, if this carries on, we will have horse manure 5 meters high in all the main streets around the world. And of course, kids in those days, there weren't many gardens, so kids were playing. I don't need to go on. Right. This time, of course, we've got the similar environmental issue with climate change, where we say, look, if we carry on like this, if we go beyond 1.5 degrees, COP30 is reminding us that at the moment, we're going to have even more storms, even more chaos, and so on. So you've got an environmental push there, but you had Henry Ford coming along with his concept of the production line, and being, I can sell you any color Model T Ford you like, Frank, as long as you want black. Now, the digital revolution means we've got that similar for people like Uber and so on. We can do, transport as a service because of those two things coming together, that we've got this new opportunity of rethinking how we do it. And that's, my point is really that every business now has to rethink how it's going to operate in the way that we did after, the fall of the Berlin Wall. And up till then, you were operating within country boundaries, and then suddenly you moved into a global business. Now we've been moving in a global business, and actually we have to move into being a service business. Today, what we're doing is we're moving away from that global business into more of a service-based business again. And the thing is, some people did incredibly well from the move into globalization, and some people will do incredibly well from the move into a service-based business. Others will, we're going to have winners and losers here.
Do you think as well that investors or traders, but let's say investors, do you think investors as well are like too much old-fashioned, paying too much attention to like old business models when they turn into investing their money? Or how would you think they should transition from older business models to newer ones?
Well, I think there's always been two streams of investment. There's been the people who look at valuation and price earnings ratios and think about the detailed study of what is going to be a good company, what's a bad company, and so on. And they don't always get it right, but they're on the right side of history. And the people who just do what everybody else says. And we've been in a market of FOMO, fear of missing out. Oh, let's jump in. We don't know what's going on, but we'll buy. And so you've got these, as we were saying at the start, you've got these absolutely stupid valuations. And I say that, and you say, well, have fun staying poor, Paul. Yeah, I'm making money and you're not. Well, okay, I can live with that. Because I know that at the end of the day, the valuation methodology will keep me out of trouble, and the momentum philosophy will get us into major trouble, and people will lose everything they've had and more if they're not very careful. So we've lived with these things for a long time, and one gets out of hand with the other. I mean, you tend to have, there's an interesting piece in the Wall Street Journal yesterday, actually, where he was saying, we've really missed the fact that we haven't had a major downturn since 2008. And actually, 2008 wasn't a proper downturn because the central banks rushed in and put lots and lots of money in and bailed everybody out and so on. So you've got a generation of investors who don't actually know that what it's like when things go bad. Very similar, unfortunately, to 1929, and very similar to 2000. If you remember 2000, the Nasdaq went down 80%. The S&P 500 went down 50%. Oh, that's not possible. Well, look at the valuations. The valuations are exactly at those sort of levels for the Magnificent Seven. I mean, Tesla. I'm sure I get abuse for saying this, but Tesla can't run a robo-taxi. It's quite clear they haven't got the LiDAR technology that you need. They're stuck. They do their trials. They've got, for safety reasons, they've got to have a safety driver in the car. Waymo, for example, which is the old on the other side, the Alphabet, the old Google car, has done 100 million miles of autonomous driving. Baidu in China has done 100 million miles of autonomous driving. So you're already getting winners and losers. The fact that Tesla is on a price earnings ratio of 300, well, yeah, it's been a fun run. Good for you, but I wouldn't expect it to continue at 300 forever, and that wouldn't be because its earnings will go up.
So how would you say traders should adjust for a low demand world when it's more like focused or not demand driven, but more like services driven? How would you say we should act as a trader differently?
Yeah, well, if we're trading, and I've been a trader. I was an oil trader in Houston, so I understand. When you're working on short term and when you're working on long term horizons, and that is Frank. That's a very valuable point. That I think you have to decide: am I more comfortable thinking short term, or am I more comfortable thinking long term? Because both can make money. Bulls and bears can both make money, but pigs don't. And so, if you want to be a trader, what one has to look at. I mean, what's the thing that really worries me today? It's what's going on in Japan with the deficit and the currency. And we are very strongly of the belief that we are going to see a second Asian financial crisis, but on a much bigger scale than in the 1990s. And the reason for that is demographic, because Japan has the oldest population in the world. Its GDP is actually declining. Its population is declining. It doesn't want more immigrants or anything like that. So which is fine. That's the decision for it. But what Abe did was he pumped up the economy with a vast amount of debt. So you've got the highest level of debt of any individual country, apart from China, of course, in Japan. And now what you're seeing is people are starting. This is the trading side of it. People are starting to say, well, they're never going to be able to repay this debt. So I don't mind lending to you if there's a chance that you're going to repay it. But if you're not, it's really nice to meet you, Frank, and thanks very much for the beer. But I think if you wouldn't mind, I'll pass on that deal. I know it's great, but I'm going to leave it for someone else because, I've got a few other things that I need to think about. And you're seeing that, you're seeing the 10, the 20 and 30-year yield moving up and moving up and moving up. And the Bank of Japan is in an impossible position now. If it wants to defend the currency, if it wants to keep the yen below 150 or so, it's 154 or something last time I looked yesterday, 154 yen to the dollar. If it wants to keep it below that, then it's got to put up interest rates. Putting up interest rates slows the economy even more, creates more domestic angst from people. If it allows interest rates to stay where they are, then the yen starts to lose more value. I think, personally, that the yen will move to 175 and maybe to 200. And I see there are some other people that I respect who are saying similar things. So if that happens, then, and of course we've now got this major spat going on, this war of words between Beijing and Tokyo over Taiwan. And so you say to yourself, well, in 1997, 1998, with the financial crisis, at least everybody could get together in the same room, and the Americans were there, and they said, come on, let's get this sorted out, and so on. And they did. But A, Asia is much bigger as a financial market today, and B, I don't see the US Treasury or the US government taking much interest in this or knowing what to do if they did take an interest. And I do see major frictions, geopolitical frictions coming in. Yeah. So my answer to your question is that's where I see the real weakness, actually. And I would be trying at this moment not to be too clever. I'd be trying to hide under the covers.
Mark Faber in Chiang Mai, when I interviewed him recently, he said how to navigate a crisis when you lose less. Your neighbor loses 70% and you lose less than 70%. Your way of handling a crisis is slightly different. Speaking of the beer, last question, what's the biggest surprise you would have for 2026? Or what's the biggest surprise you would kind of see in markets 2026 next year?
Well, I do think that it will be an Asian financial crisis. We've been talking about this, as you know, for a couple of years now, because these things do take time to develop. And, one of our jobs is to give people a lot of advance warning. When we looked at from 2005 onwards, we were warning in our own notes in the Financial Times and elsewhere about there's going to be this massive subprime crisis. And people said to us, you don't know what you're talking about. And we went, oh, yes, we really, really do. And it turned out that we were right. And actually, we got some credit for it from people in the financial community for doing that. And we wrote our book and so on, as you know. And we're in that same position now where we've been saying, look, guys, this is the issue. And people, again, saying, you don't know what. Look, I first came out to Asia in 1987. I really do understand something about the place and what's happening. I'm not just sitting in an office somewhere, reading a screen. I understand it, and I'm not, and so I think that's going to be the sudden surprise. Everybody's focused on the AI bubble and so on. Of course, it's an AI bubble. Yes, fine, but we know about that, and yes, I see Peter Thiel sold all his Nvidia shares. Well, pretty clearly, if Peter Thiel is selling them, everybody ought to, and anybody who's forgotten to do that or doesn't notice, well, they're not going to do very well. But that's a known. What I'm interested in is the concept of known unknowns. And, in other words, we know there's a problem. How is it going to sort itself out? And that, I don't know how an Asian financial crisis would sort itself out. And that's what worries me.
Guys, thanks for tuning in. And Paul, a pleasure as usual. And now we get you a slightly different angle about markets. I really like your insights as usual. We should kind of get together more often. It's been a while that we last talked. So thanks a lot for your time. And guys, please just don't forget to subscribe, obviously, to our channel. Don't hesitate to leave any comments. And I will push Paul to answer your questions as well, if I can't answer them myself, which I guess I should really get him back on the microphone at some point soon, because Paul's insights are really extraordinary. And Paul, many thanks again for your time, and
it's great to catch up again, Frank. Thanks very much indeed.